So moving on to business taxes, I'd like to start with corporation tax rates. We've got a 19% corporation tax rate here in the UK, and it's been like that since 2017. We were expecting at one stage for the rate to fall to 17% with effect from April 2020, but we did know in advance of yesterday's budget that that wasn't going to happen. But if you look historically and you look back at the chart here, you'll see that our corporation tax rates have been much, much higher in the past. Where we had a tiered approach to our corporation tax, we had rates of 32.75%, and the current rate, therefore, of 19% is very low compared to those historic rates. But how does this compare? If we look at other economies and other jurisdictions, where does the UK compare? The 19% seems very low. Well, I think it compares very favourably. You will see that in comparison to the G7, the average there is 27.65%, so our 19% rate does mean that the UK is a good place to do business. Moving on to some other corporation tax changes, non-UK resident companies with property income are now chargeable to corporation tax. Until April of this year, they've been chargeable to income tax rates. So there have been some changes there. And we also have some changes to the capital loss restrictions. Since April 2017, we have had quite a flexible corporate tax loss regime and have been able to allocate losses within a group scenario, brought forward losses against current profits and future profits. That was very welcome and very flexible. We've seen some changes this year that look at losses in respect of the brought forward losses against chargeable gains, where only 50% of those gains carried forward can be used against those chargeable gains. There is an overriding £5 million loss relief available before that 50% kicks in though, so it shouldn't affect too many people. Research and development, I think research and development features in every single budget. It's still a really big focus for the government, and they have ambitious targets to make the UK, one of the scientific and research centres of the whole world. They have a target of increasing the public and private investment to 2.4% of GDP. That hasn't actually changed this year in the budget, and actually that target is a target the government are hoping to reach by 2027. So what has changed this year? Well, large companies where you have over 500 employees and either over 100 million euro turnover or 86 million balance sheets get an above-the-line tax credit, which is deducted in arriving at their corporation taxable profits. And that rate this year, the RDEC is what that's called, that percentage has increased from 12 to 13% with effect from 1st of April. We're also going to see some consultation on qualifying costs on data and cloud computing. We don't know exactly what that means, but what that means is any investment in data and cloud computing should qualify, but we do need some further information to tell you more. There's also a further consultation on the cap that is being introduced in relation to the PAYE levels that have been paid by companies. Until now, they did announce at the last budget they wanted to look and restrict the amount that could be repayable to loss-making companies to 3 times the pay-as-you-earn levels that they've paid. They're now reducing that back and taking it back a year and also having a look at it to make sure it does achieve what they want to intend. Remember, R&D is a great tax relief. It's 230% for a small and medium enterprise and 14.5% where you're a loss-making company and surrendering those losses. Capital allowances, we've seen some changes here that we weren't necessarily expecting, particularly with the annual investment allowance. At the moment, and until January 2021, you have an allowance of £1 million, whereby you get 100% tax relief on your first million of capital spend. They are now reducing that with effect from January next year down to £200,000. It's been chopping and changing since it was introduced back in 2010. It started at a level of £50,000, it's been up to 100, down to 25, then at 250, up at 500, down at 200, up at £1 million, and now going down to £200,000. The timing of your capital expenditure will be very important, particularly where your accounting period breaches that change in the rate from the 1st of January 2021. Our plant pool capital allowances remain at 18%, and our special integral asset rate of 6% still continues, and 100% first-year allowances are extended in enterprise zones through to 31st of March 2021. Capital allowances on business cars. Electric cars are now becoming more efficient, and so they're reducing the banding. They have extended first-year allowances, so 100% first-year allowances through to April 2025, but they're reducing the CO2 emissions whereby you can get that 100% allowance. So in 2021, if you have a car between 51 and 110 grams per kilometre of CO2 emission, you can get 18% main pool allowance. If it's below 50 grams, then you get 100%. Those rates change from next year in 2020, 21, 22 to reduce them down still further. So you have to have a zero emission car to get a full 100% first year allowance. So you may need to consider bringing forward your investment in low emission cars and look at your timing of your expenditure. Electric charging points at work will also continue to get 100% first year allowances right the way through to March 2023, and you can provide electricity in charging points to your employees for their cars without any tax implication or benefit in kind. Capital allowances on structures and buildings allowances. This was introduced in the last budget back in October 2018, and a 2% flat rate allowances over 50 years ownership of the building. They've increased that to 3%, so it now brings down the period over which you can claim allowances to 33%, to 33 years I should say, and accelerates those allowances, which is good news. One key point about this is that the cost of land doesn't qualify, but all construction and demolition costs do indeed qualify, and if you come to sell a building that qualified, there is no balancing charge on the sale. You merely pass your unused allowances to the purchaser of the building for writing down a tax relief over the remaining period, over the tax period. Off-payroll working in IR35. Changes being introduced from 1st of April 2020. They've hit the press quite a lot recently, I think it's fair to say, in the last 12 months. These are anti-avoidance rules where if it were not for the fact that somebody has formed their own personal service company, the relationship between the engager and the worker would be of an employed nature. But along the way, somebody has introduced a personal service company in there to make sure they're not liable to PAYE. So this was first rolled out in the public sector a couple of years ago, and it's now being pushed out into the private sector, but it's only for medium and large companies where you need to meet 2 of the 3 conditions set out on the slide. This pushes the responsibility to the people engaging the worker to make sure whether they need to apply PAYE or otherwise. As I've said, you do need to look at the nature of the work and the control and rights of substitution, etc., to actually work out whether there should be an employed relationship. There have been some headline cases in the last 12 months. Lorraine Kelly is one of them, where she argued that her personal service company was a bona fide commercial personal service company, and that PAYE did not need to be applied to her earnings. And that was because she was a persona. She had control over what she was doing, what she was saying, how she designed her shows, what she was wearing, and she merely turned up at the studio to record it. And she actually won that argument through the courts with HMRC. There's also been another case recently of Eamon Holmes. Eamon Holmes, I'm afraid, wasn't quite so successful, and he lost his appeal on the basis that he didn't have that level of significant control over what he was doing. He was in a far more controlled environment. So the rules are there to make sure that people actually pay more PAYE where it's applicable. And in this next example, you'll see I've looked at a contractor who's charging £600 a day and what this really means under the new rules. What it means is, though that person engaging the worker will need to pay national insurance, employer's national insurance, but also the tax regime and national insurance regime that both parties will pay means that if you work it through, the additional cost to the client will be an extra £126 per day for that contractor to have the same amount of money net in their pocket each day from their work. Somewhere along the line, there's an awful really big increase in our tax regime, and I don't quite see how everybody's going to be afford to really take it all the way through to the end. Other announcement, digital tax services. This has been pre-announced, and this is for large companies with over 500 million global revenue from search engines, social media platforms and online marketplaces operating in the UK. And it's a 2% tax charge. We've got a new plastic packaging tax of £200 per tonne for packaging which is less than 30% recycled plastic, and that's going to be introduced in 2 years' time for both manufacturers and importers. We also have tax-free employer funding for welfare counselling extended to include related medical treatments such as CBT treatment and counselling, and the focus on wellbeing and mental health issues has also been recognised. The loan charge review. This is anti-avoidance rules, and there's been a bit of a U-turn in this respect. Basically, some time ago, companies were taking advice whereby employee benefit trusts were created. The idea there was a company would make a contribution into an employee benefit trust. The employee benefit trust would then loan back to the shareholder and owner of the company the money that had been contributed. HMRC saw this as tax evasion and have been fighting to try and recover the tax on historical contributions of this type. There's been various U-turns. There's been new legislation introduced in 2019 whereby people had to pay back to HMRC and make a disclosure. People have done that and they have paid the tax, but there has been a bit of a U-turn in that it only affects arrangements that have been in place since the 9th of December 2010. So some people are due their money back, and the rules and legislation being introduced in this budget will allow them to get their money back, but they will have to wait until the summer to get it, I'm afraid. Avoidance, evasion and non-compliance. I've got a couple of slides to finish here just to show you that HMRC are still targeting this. They are really cracking down on those that are providing tax avoidance schemes in the market, and we are set to see a strategy document that is focusing upon the close down of those type of operators. Where we've got cross-border arrangements that seek to avoid tax, you'll need to register with HMRC in some circumstances. There are some further changes within the construction industry scheme. HMRC don't like construction, they don't like the building sector. They perceive it to be non-compliant, and they keep continuing with further rules year to year. The hidden economy, cash trades in particular, such as taxi drivers, private hire, scrap metal, all these trades that HMRC look down, I think, and view them as being non-compliant. They're now saying that unless they comply, unless they register with HMRC, they won't be able to renew their licences. I think it's one thing to talk about registration with HMRC, but how they're going to police the idea of whether they're making a full and complete return is a very different matter, and we'll have to wait and see just how that works. And finally, they're going to also look at the standards of tax advice and the tax conditionality, whereby companies will only be able to have access to government awards, to grants, to licences and approvals where they are compliant. And finally, as I say, they're looking at the standards of tax advice and tax advice for those that provide it to make sure that the people in the sector are operating responsibly and providing good, solid tax advice within the remit of the legislation. Thank you.